Good evening, everyone. Welcome for those who have joined or will join shortly. Thank you for joining our webinar on how to turn 100,000 savings or equity into a multi-property portfolio in 2026. So, few housekeeping rules. This webinar is being recorded. A link to the recording will be shared with all the participants after the session. To avoid background noise, please keep yourself on mute while speakers are presenting. This helps maintain audio quality for everyone. We will have a dedicated Q&A session at the end. Please type your question into the chat box as they come up. We will address as many as possible during the Q&A. If the time runs short, feel free to contact us afterward. We'll make sure your questions are answered. So let's start with the introduction of our presenter, Rohit and Tom.
Yep. So it is both of us who are presenting. So I am basically director and founder of a buyer's agency called InvestTrade, and I'm a buyer's agent myself. And along with myself, I'm joined by Tom, who is a mortgage broker who is running his own mortgage broking firm with the name Wombat Home Loans. So we'll get started. So I'll just start with a bit of background of myself. So I moved to Australia as an immigrant in 2017 on a permanent residency visa after having a decade of experience in IT back in India. And I bought my first property in 2019. And after that, in the last 6-7 years, I built a portfolio of now 13 properties worth between 13 and $14 million. And 8 of these assets were acquired in the initial 3 years of my portfolio journey between 2019 to 2022, while I was working at my Combank, my data engineering manager role in Combank. So today I help Australians build scalable portfolios, exactly using the same knowledge that I built while building my portfolios and of my clients. So I have been featured on multiple, if you Google, you should be able to find out. So I'm featured on multiple news articles, real estate articles. I've featured on multiple podcasts. So there are multiple podcasts which has been released in the last 2 weeks, and there are a few more coming in the next few months. A bit about myself, I'll hand it over to Tom for your introduction now.
You didn't have my podcast on there. Only the big
Yeah.
ones.
Yeah.
Yeah. Hey, everyone. So I'm from the UK originally. I came over in 2010. And as you can see here, I spent 10 years in various investment banking roles in London. So got some good finance background there. I came to Australia, met my wife in London, and I worked at Combank for most of the time here. So 10 plus years doing that before I started my own mortgage broking business, Wombat Home Loans. And I connected with Rohit through that sort of journey.
Okay, so before we move further, I would like to read the disclaimer. The information provided in this webinar is for general informational purposes only and does not constitute financial, legal, tax, accounting, or property advice. It has not taken into account your individual objectives or personal circumstances. Before acting on any of the content, we strongly recommend seek advice from a qualified and independent professional relevant to your situation. Thanks. Let's proceed with the rest of the slide, right? Over to you.
Perfect. Thank you, Deepak. Okay, perfect. So let's get into the stuff now. So see, most Australians will never be able to build a portfolio, and that is the fact, right? So I just don't mean to be rude here, but I'm just telling you the fact, knowing what I know, and when I'm talking to so many professionals and related to property these days, right? So many people are just focusing on buying the assets without having a strategy in place, which basically means that they start hitting the bottlenecks very soon, right? So it's not because they can't build it, it's just because they follow the wrong strategy from day one, and that gets them reaching their desired outcome, right? So today we are going to show you on how someone with only 100K can get started correctly and then build a multi-property portfolio, right? So it's not get rich quick scheme. It takes time, but again, getting in the right direction and taking the right steps will actually take you there where you want to be. So we'll move on to the next one. What you learned today, right? Why serious investors want to build portfolios, right? So we'll learn about why property portfolio is important, and we'll also discuss a 3-phase property game plan. We'll also discuss how someone with 100 can get started. We'll share an example with you on how one of our clients got started recently with a similar deposit. And then real estate portfolio journey is a game of finance, right? So you have to play it well. We will be discussing about solving your deposit and borrowing capacity bottlenecks, and then we'll take a real case study of one of our clients and show you like how he has done it successfully. There are many examples, but just in interest of time, we'll be going through one of them. So we'll move on. So when we are talking property portfolio is nothing but a collection of properties, right? It could be a collection of your owner occupier purchase along with other investment properties, or if you are rent vesting, which means you are renting at the moment and investing, then it could be just collection of your investment properties, right? So it could be owned by a single investor. It could be owned in a family name. Two partners can be owning it that in joint name, or it could be owned under entities like family trust structures or companies, right? So the intention of property portfolio, anyone who's actually planning to build a portfolio, is that they want to build wealth and have passive income. So there could be different goals that people are usually trying to chase from property portfolio. That could be generational wealth, that could be building generational wealth for the next generation, that could also be having a passive income in their retirement stage, or that could also be an early retirement so that you can have choices much early in your life, right? So that is the benefit of property portfolio. So property portfolio again is nothing but a collection of properties, right? So we'll move on. So why investors build property portfolio? The first and most important reason is because when you have got a collection of properties, the compounding at scales works much better, right? Because if you are having $1 million portfolio and that is growing at 5% annually, then it just means that you are getting 50,000 rich every year. But if that portfolio grows to $10 million worth, and then that 10 million, even at the same rate of 5%, means you are getting rich by $500,000 each year, right? So compounding at scale actually changes the game altogether, and then that gives you the real wealth, right? And then compounding growth is basically that you are building wealth over time. You are buying a property today with an objective of achieving a goal, right? So you are basically building wealth over time by acquiring these assets correctly, and then compounding is doing its magic, right? And then diversifying risk is again very crucial factor, because when you are investing in multiple properties rather than a single asset, then you are just not at the mercy of that particular market for your portfolio to be going up and down, right? Because you are diversifying your risk. So say for example, if a market takes a hit, so say for example, somebody who has invested in just Melbourne, and I've got a few clients like who were just local investors, been in Melbourne, have bought 5 properties in Melbourne, but the biggest impact to them is because they have bought everything in a single location, or if they have bought a much expensive property but a single asset in Melbourne, then they, in the last 5 years, they haven't had much significant growth, right? So getting properties in different locations and having your property split into multiple properties in different locations spreads your risk. But also the other benefit that you get is the market cycles, right? Because each property market has got its own cycles. So when you are investing in multiple properties in different markets, you are taking the benefit of different market cycle timings. So there would be like your whole portfolio never stagnates altogether, right? So if one property market is actually cooling down, then there are other markets which could be uplifting your overall property, your net worth or your property value, right? Just because you are invested also in a growing market. So very crucial. So one property growing at 5%, as mentioned, is a small gain, but 5 properties growing at 5%, life-changing gains. Another thing that I wanted to mention about compounding growth was when you are buying a property, the whole of the property is not belonging to you, honestly, because you are taking a mortgage on that. You could have paid 10 or 20% deposit. The remaining 80-90% is bank's money, but whatever growth you get is entirely yours. So if you've just invested 10% and the property grows by 10% on its overall value, your investment is actually doubling. So that is another beautiful concept of leverage, which I think sets property apart very much different than the other asset classes. Okay, so this is a 3-phase property game plan. I've actually done a dedicated webinar on that, for which you can actually find a recording on our YouTube channel with the name InvestTrade. But I'll just briefly touch upon the same concept here. Property portfolio building is very similar to bodybuilding. So in bodybuilding, you basically have 3 phases. The first phase is the bulking phase, right? And in property, you have got acquisition phase. So in bulking phase, you want to go as big as possible. Here in acquisition phase, you want to go as hard as possible and acquire as many properties as possible in the shortest time frame. That is your acquisition phase. And then in bodybuilding, you have got leaning or cutting phase, where you are wanting to cut the waste. Here you have got consolidation phase, where say for example, you have bought 5 properties. These properties have doubled in value. You want to pay off the debt on some of them. So you basically sell a few, pay the debt, pay taxes, and then you're holding some assets debt free, which basically then takes you to the third stage, which is passive income and retirement stage, because now these assets are paid off, then they start giving you passive income. If that is one of your goal. In bodybuilding, it is actually a maintenance phase. So very similar to someone in bodybuilding. So you can have that analogy and understand. And usually out of these phases, acquisition phase is the longest phase, because you need to buy properties looking at the market cycle timings and then give them enough time to grow, which I'll be covering in the next slide. Okay, so this is what the acquisition phase looks like, right? So when you are buying properties, you want to buy as many properties as possible, again, in looking at the market cycle timings, because market cycle timing will do the heavy lifting for you, right? So you want to tap into the right markets which has got good supply and demand fundamentals, so that your property has got the fastest growth possible, and then you basically reuse this growth to acquire more assets, which Tom will be touching upon later in the presentation. So in this, say for example, if somebody's acquisition phase is 10 years and their goal is to acquire 5 properties, then they don't want to be buying one property every second year, because if you do that, then to the last 2 properties you have not given them enough time for them to grow. So if I
think the point that I take away from this, and
Yeah.
I know you focus on, is just moving the locations around. Every location in Australia is doing things at different times. And so knowing trying to predict when those are going to happen is where you're going to see the genuine growth,
100%.
or outsized growth.
Yeah.
So it's not just about a cadence of buy every 2 years or something.
100%.
The location is
Key.
critical there.
Exactly. And also, like, when you're acquiring these assets, you are paying attention to the market cycle timings, but then you're timing the markets here correctly, right? For you to be able to do it successfully. But then you want to give each of these assets enough time in the market so that the compounding does its magic, right? And that's what leads you to the next stage of consolidation. So most investors at the moment are buying with emotions, which is actually leading them. And I keep working, see, as our name suggests, right, we only work with investors. So our name is Investor Aid. We aid investors. So we are working with investors every day of the week. So, and this is the most common problem that I see. People have got biases or emotions, or some of their knowns have bought in certain locations, and they make their purchase decisions on the basis of that and not look at the fundamentals, right? But smart investors always buy based on timings. They don't want to be buying in Brisbane, Adelaide, or even Perth at this stage, because the last 5 years have really been a massive growth of phase. Now they are likely to stagnate. No one knows when, but again, I would assume that to be pretty soon.
All right.
Okay.
Let's get into the 100,000, which is in the title of this presentation. And this is assuming that you're starting on your portfolio journey. You're going to need to come up with some cash. There's no 2 ways about it. And this is really here to just make you think creatively about how you're going to get that. So the obvious one here is cash savings. You take your bonus from your salary, you're saving regular amounts each month. That's probably what most people would think about. But really here, you want to get creative. You want to be asking your family. You want to be looking at potential joint ventures. That could be with friends, could be with family, partners. Other people might be able to help you get started. Because once you've got started, then the ball is rolling and then things become easier. But getting that first 100 is critical. Now, later on, you can do things like equity release, SMSF, starting to use your super, but those come later. So that's really the purpose here. Is there may be others, but think creatively about how you can raise that money.
Yep.
Once you've got the money, in this case, we're using 100 as the example, this is where it gets spent. So on the right there is a nice chart which shows the different buckets that money will be spent in. And based on the example we've got here, which is somebody buying a house in New South Wales for 610, this is a real example. Rohit actually bought this property recently. This is the breakdown of where that money gets spent. So deposit is the main one. 10% is a typical deposit. There's flexibility with that as well, and we can get into that separately. But there are fees, sort of solicitors, accountants, and so on. But stamp duty is really taking another major chunk. That's going to the government. Not much we can do about there. That will vary by state, and so that's another consideration. Victoria is typically a bit higher. And then you always want a bit of a buffer for things that go wrong. Maybe there's some repairs that need to be taken. But yeah, this property, look, rented out pretty well. It's 4.69 yield, and that's going to start someone off very well. I presume this is the first time.
That is correct. Yeah, this was their first purchase. So this guy only had 100K, and this is how it got allocated. We bought this property in regional NSW, very favorable supply and demand data metrics. And the rent, it got rented, like I think for in the first week itself at 550 per week. And yeah, great demand for rental, and like this market is moving every month.
Awesome.
Yep.
Let's move on. So yeah, mind shift is a big one. And I think we would probably keep coming back to this. One of the main limiting factors of buying property is the deposit, right? And you can't just buy with a lender alone. They're not going to give you 100% of the money to keep buying more property. So you need to find those funds. Now, a traditional path, or the slow path, if you like, would be that you save that money yourself, saving the coins every month, or using your bonus, maybe asking for handouts from family and so on. That's relevant for the first purchase, but you don't necessarily need to be using that approach ongoing. Once you've got a property, you can then actually leverage that in itself. And we'll get into that in a bit more in the next slide. But this is where the power of building a portfolio allows you to speed the process up, because you're going to tap into growth in the various markets that you're going to get into.
And hence the market cycle timings get very crucial, because then if you are looking at the markets correctly and getting into the right markets, which will be rising in next 6 to 12 months, that basically gives you the deposit for the next one.
Yeah, this slide slightly illustrates it slightly better. This is the flywheel essentially that you want to be getting on. So once you've got that initial deposit, you've bought that initial house, you want to be waiting for their capital growth that's going to happen. It's so far the fundamentals in Australia are luckily very favorable. We've got increasing population, shortage of housing, and the underlying dynamics of this market are very strong. Each market within the various states is going to move at different times, but if you buy well and your asset appreciates in value, you're going to be able to take out equity from that to reuse for the next property. And so this is a cycle that just keeps on going around, and you're not necessarily, maybe in the first one or two, you're going to need to come up with your own funds. And I'm not saying you won't need that in the future, but the majority of the work gets done in the early purchases. And then this capital growth cycle is something that can start going round and round.
That is so true. And also there is a snowball effect here. Say, for example, if you end up buying your first property and you get into the right markets, in 6, 12 months, it gives you some deposit, but then which you use in order to get to the next one. But if you again do the same thing, get into the best markets at that point in time, then you have got 2 properties which will be coming up with your deposit much sooner. And then there is a snowball effect when you get to 3 or 4 properties. If you keep buying correctly, then at some stage you'll start realizing that you always have got a lot more deposit or equity available for you than you can use. And that is how you start creating a difference between what you owe to the bank versus what your net worth of the portfolio is.
Yes, and you're talking timing here, because
Very
really
true. Yeah.
the quicker that first hit can start appreciating in value, it's arguably one of the most important purchases.
Always.
Right.
Yeah.
So,
the foundation is, yeah, that's the
because you
foundation.
can't, it's a lot harder to move on to number 2 without that capital growth.
That is correct. Yeah. And then if you keep doing that successfully, the faster you grow. Perfect. So I'll explain a bit about where, because we keep hearing a lot then it is our growth versus yield. And I've done on other presentations, I've done multiple seminars and webinars on this topic. And the topic was how to build a sustainable and sizable property portfolio. So I just want to call it out. Growth and yield both are important for someone who's starting out. So once you have built a portfolio significantly big enough, then you can be a bit more creative, a bit more focused on just growth or just yield. And then you may have options, but for someone starting out, growth and yield are equally important, right? The reason is because growth is focusing on it focuses on the property value to be increasing over time. That's what growth means, right? And it's all driven by demand, scarcity, and market cycles, and not just the location, right? If you are getting into the best locations with all ocean views, it may or may not be the best market where capital growth may happen. There are a lot more demand and supply metrics and the market cycle timings that you need to look into to have the best capital growth possible. And the role of growth in your portfolio is because this helps you build the equity, which can be used as a deposit to fund the next purchase. And also this capital growth is what is going to be generating your net worth. And then when we are talking about yield, here the focus is on the rental income related to the property. So when we are talking residential real estate, all we are talking is a gross rental yields, and it's a very easy formula. You basically take a weekly rent, multiply that by 52, and then divide that by the property purchase price, multiply that by 100, basically gives you a percentage yield, right? So the gross rental yield, so the higher it is, the better it is for you, because it helps you in sustainability, because you're, and from cash flow perspective, right? So it basically helps you in your holding cost, or it reduces your holding cost. And if the cash flow is good, it also helps you improve your serviceability, because essentially the rent that this property is bringing in to you gets added to your household income, and then is factored in when the bank looks at your borrowing capacity or serviceability for your subsequent purchases, right? So I always say capital growth makes you wealthy, but cash flow makes sure that you can sustain to the path to wealth. So I'll give you an example here. Just think a hypothetical case, right, where you have got a very strong conviction that if you buy this property which you are seeing in front of you, and you have got a very strong conviction that this property is going to provide you $2 million in capital growth in next 5 years, right? So if you buy that property today, but it doesn't have the required yield and it makes it unsustainable, which means that you would not be able to hold it for that 5 year period, which means you will also miss out on the capital growth, because the sustainability becomes the problem, right? So even if, in order to achieve capital growth, it has to be sustainable so that you can hold it long enough for the compounding to do its magic and let the capital growth happen, right? So very crucial, like for someone who's starting out, or if they are at their property number 2 or 3, just keep focusing on growth and yield together, because one or the other will not be basically taking you too far.
I think the extra point here is that
Yep.
you can overpay for a property. Like
Yep.
you can be spending a lot of money on an asset that's not going to actually return you very much yield.
That is correct.
In Sydney, that can be 1-2%. Like
Yeah.
it's not uncommon.
That's exactly the reason why people are getting into the affordable markets today, because the prices are affordable, but yield percentages are much better. So it makes it much more sustainable, but also then, because they are not so expensive, you can actually spend your total budget in 2 purchases or 3 purchases, rather than doing a heavy purchase in Sydney, which is
Absolutely.
the most expensive city here in Australia. Okay, so market cycle timing, as you would have seen me mentioning this a few times earlier, right? So market cycle timing is what gives you the capital growth, right? So every property market has got its own cycle, and they keep moving at different times, right? So if you know how to track the market cycle timings, you can actually get, whenever you're ready for a purchase, you can get to the best markets which will make you money in the next 6 to 12 months. So imagine a scenario where, if imagine there is a guy like myself who is just a local investor, who keep investing in a local market where he is living, because that is what he's familiar with. The biggest problem with this approach is, say for example, I am, and typically a market grows, again not talking any specific market, but typically a market goes bonkers for 3-4 years and might stagnate for 5, 7 or 10 years, right? So let's take an example like where a person like myself who is capable of buying one property each year, I've made a promise to myself, I'm buying one property each year now, but I am a local investor. Now I am investing always where I'm located, which means out of 10 years, I would only be correct 3 times out of 10. And the remaining 7 times, I'm investing in a market which is expected not to perform well. And that's the benefit of actually being a borderless investor, where then you have got the liberty, you can get into the best market regardless of their location, because your proximity to the location has got no correlation to its capital growth, right? So for following the market cycle timings gives you the maximum upside potential. And that does the heavy lifting for capital growth. 70% of the heavy lifting in capital growth is just attributed to the market cycle timing. The remaining 30% roughly, you can think about getting to the right suburbs and getting to the right streets and getting to the right asset. But say for example, if you would have picked, you blindfolded yourself, you would have picked any random asset in Brisbane, Adelaide or Perth, regardless where it was, it would have done significantly well, as opposed to picking the best asset in Melbourne 5 years ago. So market cycle timing does the heavy lifting, then the remaining 30% is just everything else.
But I think when you say market, it's the same as location, or is it?
Oh yeah,
is it
exactly.
different to
So
you?
market cycle timing is actually specific to a region or a location. And when I'm saying markets, I'm not referring to states here, I'm referring to cities. Because in a state, different cities have got their own market cycle timings. So the biggest mistake, as I've mentioned, most people buy where they live and not where the growth is expected to happen. which is the biggest problem. And there is a saying, right? They say known devil is better than an unknown angel. So they are, because they are familiar, even. Yeah. Okay, perfect. So then once you have, so when you're selecting the growth regions, right? As I mentioned earlier, market cycle timing is super crucial, but then also you want to be looking at the population growth, because if, see, when we are talking about price growths, they are nothing but always a factor about demand and supply, right? So population growth is the demand factor, right? So you want to be investing in markets where the population growth is happening rather than investing in a market where they're losing population. And infrastructure spent by the federal and the state is again crucial. Then also you want to pay attention to the economic diversity, because if everything else stacks up but there is no economic diversity, then you are risking too much. And Gladstone has been a good example for that. We have traveled there, and after traveling there, staying there for a few days, we decided, though the supply and demand fundamentals were awesome, we decided we won't be buying there for any of our clients for exactly the economic diversity as the reason, because it just didn't have that. So once you have decided on the region, then you basically start looking at the suburb, right? That is your next level of filtering. So you want to pick the best suburbs in that region, maybe filter 3 to 5 suburbs, depending upon how hot the market is. Because if the market is too hot, you don't want to be picking 2 or 3 suburbs. You might want to pick 5. So then you start looking at supply and demand metrics. So there are multiple metrics that you can look at. I've just mentioned a few here for just to save some time, but then there are more metrics, right? Vacancy rate is again very crucial. You want to be looking at regions with under 3% of rental vacancy. The lower the better. Many parts of the country have got under 1% rental vacancy rate, which basically means a rental crisis. Again, you also want to look at the average days on market and look at not just the point in time information, but also the trend. Because as they say, trend is your friend, right? Looking at the trend, you can clearly understand where that market is heading and then make an informed decision. And then renter to owner percentage is again very crucial, because you want to invest in markets where renter percentage is as low as possible, because tomorrow when your property comes to the market for rental, it will have less competition. And also lower renter percentage means the owner occupancy is higher, which means the area is much more desirable because more and more people are committing to mortgages to be living there. So desirability factor is high, but the supply for rental is limited. That creates bigger pressure on even the rents. Again, stock on market, very important. You want to see how the stock on market percentage is. Stock on market percentage is nothing but, again, so as I said, like for any metric, you are not only looking at point in time, but also the trend. Stock on market is nothing but a percentage of total properties available for sale at any given point, divided by the total number of properties in the suburb. So the lower the better. And if you're looking at a trend, it should either be a flat line or declining. If a stock on market is increasing, then that could be a red flag for you. Inventory levels, again, inventory level basically means that how long will all the inventory take to just finish if no new property comes in, and it is usually in months. So if the inventory level is sitting at 1 month or less, it basically means if no new listing comes in, everything will be gone within the time frame. So the lower the better as is. So it again tells you supply side. Building approvals tells you supply side. Again, it is usually a combination of DA approvals and CDC approvals. So building approvals at best case scenario, you just want to be having declining trend or at max flat, but you don't want to be investing in suburb where building approvals are climbing. And as I said, when demand outpaces supply, that's when the growth happens. Okay, so deposit bottleneck is just give me a second. Okay, so I'll cover this. Okay, so most investors don't fall behind because of income, right? So the first bottleneck every investor that they'll be facing is the deposit. And that is what Tom also explained, like a real right purchase can actually solve your deposit problems down the track, because saving a deposit takes a very long time, right? You might take a year or two or even longer sometimes if you are saving 10-20%, right? And by the time you actually save money, the market also keeps moving during that time frame. So there is a missed opportunity there if you are just relying on your savings. And longer gaps between property purchases actually just elongates your acquisition phase quite a lot. So as I said earlier, like in your acquisition phase, you want to go as fast as possible and as hard as possible. In order for that to happen, you want the properties to be doing the heavy lifting for you rather than you trying to do it yourself, saving every cent that you can. Saving your way to multiple properties is the slowest way to build a scalable portfolio. The slowest way. usually the property should be doing the heavy lifting for you, which means buying in the right markets become even more crucial. So deposit bottleneck is the first one, but then
Do you want to just go back
yep, sure.
for the poll? Are we going to?
Oh, sorry. Yeah.
Yeah.
So we'll have a poll here. Thank you for my reminding. Yeah.
I'm not sure if we've missed one or not.
Yes. We'll just do a poll. Maggie, can you put a poll up there? Okay. So we are asking a question, what is the biggest thing holding you back? So we are just doing a poll to see what our audience thinks. Okay, so we'll just give it another 10 seconds. So out of 32, there are 10 people who have answered. So 14 people have answered. Okay, so 14 people have answered. Saving deposit is a problem. I'll just put it here. So saving enough deposit is problem for 1. Borrowing capacity is a problem for 6 out of 14. Knowing where to buy is a problem for 5, which is interesting because I've got a specific slide for that. And fear uncertainty is 1, which is surprising to me because I keep talking to so many people each day, and like fear and uncertainty is one of the biggest one at this stage. And not sure where to start is just 1. Okay, perfect. So we will move on. Okay, so once you have gone past your deposit hurdle, then borrowing capacity becomes your next biggest challenge, right? So because buying in the right markets can solve your deposit problem, but in reality, borrowing capacity is what stops them after 2 or 3 purchases if they have sorted the deposit issue, right? Because borrowing capacity is dependent on your income and your employment stability. It also depends upon your existing debts and liabilities. It also depends upon the rental income that your investment property is bringing, because that is again tied to the income, the overall household income of the family, and then of course the how the interest rate environment is and how the lending policies are changing. So a successful investor manages both equity and borrowing capacity to be able to grow their portfolio. And then in that case, like, you definitely need to be working with an expert broker like Tom, who can then sort this out for you.
Yeah, okay. I think that
this is
ties in
over to
quite
you.
nicely with lender strategy,
That
because
is correct.
essentially your borrowing power, or where you're going to get the funds to buy this property or more, is going to come from a lender. And we'll get into the types of lenders in the next slide. But really, the goal here is to maximize your borrowing capacity at every stage of the journey, from first to last property. And there are lots of things that we can do to help that process. And again, we'll get into more detail, but that serviceability is the key. So the amount of money that a lender will actually offer you, that will support your future purchases. And like Rohit said, it will help you manage the cash flow. So I think we can delve from this into a little bit more detail in the next slide. And this can make the difference really between how quickly you can move. So it's very unlikely that you're going to be able to use just the one lender to build a whole portfolio, because unless you have huge growth in your income from your job, which might happen, let's fingers crossed, you're likely to be at different stages over the next 5 to 10 years. That might mean you're changing jobs, or it might mean you're different income levels that you're experiencing, or you've acquired new properties and you've got more debt as you move through the process. So every lender will have its own policy. So the way to think about this is to break it up into 3. So you've got your tier 1 lenders, and these are the big names that you'll recognize: the ANZ, CBA, Westpac, St. George. These are the banks that everyone knows, and they're the biggest guys in the town. They've got the policies they've got the widest policies, you could say, that will help you get started. Typically, their fees are the lowest. They've got strong reputation. They've got great tools. I came from CBA, so I was heavily involved in the digital asset build that they've got there. So there's it's a great place to get started. And it's very unlikely that we would recommend anyone doesn't use a tier 1 bank to get started. But then as time goes on, you might be looking at more of a challenger bank. So we would think in those terms of places like Ubank, ING, maybe Suncorp, HSBC. They're not it's not necessarily about how much they can lend, but they've got different policies. The serviceability might be slightly more in your favor. They might have some more niche policies that could help. So, this is maybe where you get your second, third, or fourth property from. After that, when things are getting tighter, you've got more debt. You may not yet be at the point where you've got all the growth you need to finish your journey. You might be looking at a non-bank lender, and this is where there's a huge amount of options, but this does need some careful navigation. And again, you're not unlikely to use this as your first option because they are likely to be higher rates, more costly, but you're getting an excellent service. And so some of the reasons that you might go with one of them are lower serviceability buffers, so more flexible stress tests that they apply to the lend. They might look at the assets more carefully and they might slightly value them slightly differently. Essentially, flexibility is what you're going to get from some of these lenders, and names here would include First Mac, Resimac, Liberty, but there's literally hundreds in this space. So I guess it's my job to know who these lenders are, what they offer, how they can help you at different stages. So don't get too concerned here.
Yeah. Don't get tied to a single lender.
Whether it's me or someone else, is really their job to help you. Okay.
Perfect.
This is a lot of numbers, but essentially throughout my process, when I'm working with a client, I'm looking to help understand what stage they're at and where they want to go. And I want to understand their goals and how we are going to get them the right finance at the right time. So this is part of, there's much more to this actually, part of the model that I've built over time. I come from a data analytics background, so this is my bread and butter, and we can help walk through where you are now, where you want to get to, and formulate a plan. So yeah, just know that from here that there are tools available. I'm still trying to come up with a good name for it. Yeah, I won't go too deep into this one, but I think structure is important. The banner there says that the right structure can essentially be the difference between saving you hundreds versus saving you millions or generating millions. And essentially what this means is that you can quite easily get yourself into bad positions or negative positions. And when you're buying your second property, I think this isn't probably talked about enough, but the lender you go with first wants to keep you as a borrower. They're incentivized to do that. What you need to be incredibly careful of is how you structure your next deal, second, third, fourth, and how you're releasing the equity that Rohit and I've been talking about earlier. It's not just a question of lender number one, just give me the extra funds. It's about how those are released to you. There's a tax implication, there's a hygiene implication, but there's also the flexibility of how those funds can be used. So what you don't want to be doing is tying yourself in knots, creating a web of uncertainty and sort of complexity. There are ways that this can be done. You get funds released that can be used with any lender and for any other property purchase. So that's probably, and this term is generally called cross collateralization, and it's probably one of the main structural issues to avoid. There are other things that you can use in your favor, from interest-only repayments through to lender sequencing more. But yeah, that's probably the critical thing to note, is how you move into property number two, because that will really set you up for future purchases.
And this is good. Like, I'm hearing first time from a mortgage broker who is advising against cross collateralizing, because usually I work with so many clients, right? And whenever I hear people saying, man, my broker is or my lender is telling me you don't pay a cent and everything happens from inside, and you don't do anything other than signing paperwork, then that becomes a red flag. Because usually the traditional way is like you take the equity out and then pay that as a deposit. But if somebody is just getting you paper signed up, they are possibly cross collateralizing, not necessarily, but possibly. So because it is in favor of the lender or the broker, because they are tying you closely into the relationship.
Yeah.
But that's what I'm a bit unique about Tom, because he is referring that don't cross collateralize, though it is actually favorable for him as well as the lender to retain the client with them.
I think the point there is that it might not be a problem at property two.
That is correct, yeah.
But and I
It
think
becomes a problem
3, 4,
soon
5.
after, yeah.
could be.
That is correct, yeah. And then also my learning across PNI and interest only is people say that for always, like for investments go interest only, there is no blanket rule like that, because interest only also decreases your serviceability. So if you are someone who is just always trying to squeeze one extra property with challenges, interest only may not be the best option. So work with a good broker and they'll advise you on that.
One more point I just didn't mention, I think some people might be interested, that there obviously are other structures that you can use beyond your own personal name. And this is where we get into company corporate lending or SMSF lending. Some of those things need your network or your wider network of people from accountants, advisors to come into and lawyers to come into the picture. But these are all options that we can work with, and I help people with those kinds of lending as well.
Perfect. Awesome. Okay. So this is just one of our client case studies, right, which I'm mentioning here, just to show that what happens when you do it strategically, right? So this is a client, Prabhat and Ashwini, based in Sydney. Like they live in Doonside, was working at Macquarie Bank, and they just had their principal place of residence to live in. So we bought property number 1 for them in October 23, and then we ended up buying 4 properties for them in 9 months. So you can see the combined equity that this guy has made is around 1.15 million, close enough to that. And the properties were bought in the right market cycles, and then that is the reason why they kept growing. So the first property was bought in Townsville in a beachside suburb called Bushland Beach, and that was the fantastic time to buy there. We have bought probably 70 properties just in 3 best suburbs, and they have done really well. And then the second property was bought, like if somebody remembers, like January 24, Perth was the hottest market in the country. We got an exclusive off market from a network of agent where the agent was, this property would have been sold easily for 600 because every property was getting 20, 30 offers that time. And then because I had got very good relationship with him and I had so many lunches with him in Perth, this guy, because this guy, the seller was downsizing, moving into a unit. He just, when he went there to sign a selling agency agreement, he did a FaceTime and told me, like, this property is coming to him shortly. So if I've got a buyer, he can just flick it through. So they were asking 530, which was, I think, very reasonable. And we negotiated another 15 grand. Then we bought another one in Townsville, again in a beach. Like this was not in a beachside, so this was again off market from Townsville White agent. And this was in a central suburb called Kerwin. Fourth one was again in Perth, but north of Perth in a suburb called Butler, which is a beachside suburb, very popular.
So this is all within a year?
Yeah, all 9 months. Yeah, October 23 to June 24. And there were, if you look at the rentals were also great at the time when we purchased. And also remember, like when we are looking at rentals, rental over time keep rising. These were the rentals which were at the time of purchase. The current rentals would be a lot higher. So their yield on their purchase price is actually much better than you see on the screen. This is another concept that people need to understand. Okay, I think this is where I see a lot of problem, because currently with so many podcasts and webinars, including mine, right? Like you would see everyone is trying to find an answer of where to invest, which I think is fundamentally wrong, right? So say, for example, if somebody is listening to me in a podcast and I'm being very transparent and honest and clearly telling them that I'm buying in location X, and if they follow my advice, then that's not right for them. The reason is because we are at very different stages of our portfolio journey. I'm looking at that property as my 14th purchase, as opposed to if you're doing your third purchase, then it may not suit you, right? Because first reason, we are at different stages of portfolio journey. Also, our cash flow appetite could be different. Our goals could be different, right? So what I always suggest people is that, because nobody loves brick and mortar, right? Everyone is buying property today because they are using property as a vehicle to achieve a goal or an outcome. So if you're using a property as a vehicle to achieve a goal, always start with a goal and then get clarity on your goal first before you even take your first step. Get clarity on your goal and then formulate a strategy to reach that goal. And that all has to happen before you make a purchase, because once you have made a purchase, it is very costly exercise for you to rectify any mistakes. So get clarity on your goals and then formulate a strategy to reach that goal, so that each of your asset acquisitions are aligning to that particular strategy and taking you closer to your goal. So usually for an individual or a family, unless there are major life-changing circumstances, goal and strategy doesn't change. They remain consistent. And then with changing times and changing market cycle timings, as I was previously mentioning, your region keeps changing. So that strategy might be working best in region X today, but 12 months down the track, that strategy might start working best in region Y. With changing regions, of course, the suburb changes and then the property. So always get your strategy right first before you even think about your first property. And this is where people get like logged. Acquire random asset acquisitions give you random results, and that is not what you are chasing. So make sure that each asset acquisition in your portfolio is serving a purpose. Needs to be very clear and strategic about that. Otherwise, rectifying them down the track is a very costly exercise, not just in terms of money, but also in terms of the lost opportunity. Yeah. Now we will get on to Q&As. We want to address as many questions as possible. Deepak, would you like to read the questions out, or?
Yes, if you can read it, that would be better because some of them are
That's fine.
pretty lengthy. Yeah.
Oh, no problem. So
Yeah.
I'll
Start
just
with the third one from Harry.
Harry, okay. What will happen when you can't service debt after 2 years? Two properties. Okay. So again, I'll circle back on the previous slide that I was talking, right? So this needs to be done before even you go for your property number one, because based on what you're asking, to me, it looks like that your goals or aspirations were bigger than getting two properties, but you maxed out sooner. So before you make those, because once you made those purchases, other than selling that property, there's essentially no choice, right? Which again is a costly exercise. So if you can't service your debt, which means, again, I'm assuming this to be that you are maxed out on your borrowing capacity. If you have maxed out your borrowing capacity, it basically means, see, through tiering structures, there could still be some options. But again, if your borrowing capacity becomes zero with tier one lender, it is very less likely that someone else is going to give you $700,000. Like with lending strategies, you would be able to stretch slightly. You keep pushing.
But there's a few things.
Yeah.
So lender would be one. There's a lot of lenders out there who will have different numbers for what your serviceability is. So I wouldn't just take one number from one lender and say, that's it, you're over.
That's it.
Valuing the assets, it will be done differently by different lenders.
Oh,
So
yeah.
not everyone's going to say X property one's worth 500, some
That
might
is
say
correct, yeah.
550, and that could help increase your serviceability or the amount of money you can release for the third property.
Yep.
So valuations, lender would be two critical ones. The way your income is being assessed as well, partly going into the borrowing capacity, but and asset that you're looking to purchase as well. So these kind of things are difficult to bring out in a Q&A, but
Yeah.
yeah.
And see, structuring also helps you, but again, structuring will not probably help you once you have exhausted everything. You probably have to act a bit sooner than that.
Yeah, there's trust and company type lending, but you wouldn't want to be just jumping into that right now.
That is correct.
I think that needs a lot more planning.
That
but
is
it is an option.
Exactly. Yes. My again recommendation is, you want to avoid reaching that situation. You want to be acting prior before you are hitting your serviceability ceilings, and plan it out ahead so that you can
start the plan now.
100%. Yeah. If you are there, then that's all you can do.
Yeah.
Perfect. Hope that helps. So Raj, quick question. Even equity is a loan, and loan has associated cost, and that eventually increases the repayment. However, buying and adding properties increasing these repayments, being most of the purchases properties are, how do you suggest from your expertise to handle such cost? Okay, so this is interesting. So that is completely right. So when you are taking an equity from existing property to be able to, so that you can use that as a deposit to buy next one, I would expect, even from taxation perspective, right? Again, speak to your accountant, they'll advise you better. But the new equity loan that you're taking from previous property, though the security is the previous property, but the interest on that component of the loan or that split of the loan will be claimed against the new property, because that is the purpose of that loan was to buy the new one, right? So it basically means that when you are doing your cash flow analysis, then the new purchase will factor that cost in, though it is secured against the previous one.
Able to use 100% to offset.
Essentially. Yes. So then, then the costs are definitely going to be higher, because technically you are not spending any money from your pocket and still getting an asset, if you are buying correctly, is giving you capital growth. Then you also, as in one of the slides, as I mentioned, that you need to be focusing on growth and cash flow at the same time. You still want it to be sustainable, and sustainability means different things to different people, right? Somebody on 500K annual income can sustain a lot more than somebody on a combined family income of 150 or 200, right? So it varies between people. So you need to be, again, very strategic on what works in your circumstances, right? So say, for example, if you have got the holding capacity where you can manage repayments, maybe up to $1,500 extra a month, then that defines what you can buy. So you don't want to be in a position where you actually bite more than you can chew. So you don't want to be buying an asset which is more negatively geared than 1500, because that starts hitting your cash flow, which means you will be again under a stress, right? So I think definitely properties are going to be negatively geared, but as long as you can sustain them, and then you also understand negative gearing basically means you are losing money on a property to hold, and you are losing that money today because you anticipate that the gains are going to be far greater than the loss that you are making. Because if that is not the case, then there's no point losing money, right? So you are banking on a future capital gains. So you need, so it becomes even more important for you to get these purchases right. The more negatively geared the property is, the more certainty or good certainty on the maximum upside potential should be there. Otherwise, why would you be taking a loss and suffering today?
Yeah, and then this is the sort of thing that we model out during the process.
100%.
You don't want to be going into something like this blind.
Yeah.
So there's ways to calculate what that could look like.
100%. So which basically means, like, to summarize a response, you always want to be doing a cash flow analysis for all your subsequent purchases before you make them. And that should help you. Hope that answers your question, Suraj. Okay, so if I buy off the plan in a growing area by giving minimum deposit that settles in 1 year, by the time it settles, I would have already gained equity. Is that a decent alternative? I'm looking at off the plans and so, man, I am always against off the plans. Okay, and I don't mean to say that off the plan doesn't grow. It is, again, if you go again back to our slides, it's not the off the plan which is making it grow. It is the market cycle timing which is going to be making it grow. So if you look at any of the plans based in Sydney or Melbourne, where people have made money, they have made far more money in buying an existing real estate in exactly same markets, because it was not off the plan which made them money, it was the market cycle timing. I'll give you an example. Say, for example, back in 2020, if you are looking at properties under 2019 in greenfield developments like Marsden Park or Box Hill in Sydney, these areas you were getting house and land packages for $1 million and or 900,000, and at the same time you can get an existing asset, exactly same asset with same land component, similar build, for 800, right? So you can actually get an off the plan, sorry, the existing real estate much cheaper, and today 5 years later both of them are same price. So you are making more money in an existing real estate. So always understand, like, off the plan doesn't make you money, but if off the plan is the only option for you to get into your foot in the door and you really can't get otherwise, then yeah, that's fine. But just make sure you are getting into the markets, looking at market cycle timing, because that is what is going to make you money. I also know a lot of the plan purchases that people, I've seen lot of the plan purchases going sideways, where people have got into those contracts with 5% deposits, and by the time they settle, they are willing to just leave their deposit and run away, and they have got some liabilities there, because either the property gets valued lower because the market has not shifted. And also understand, market growth versus what the developer is increasing in their prices is very different. So you would always see developer doing smaller releases every second week or every fourth week, and they are increasing prices, and that looks like a capital growth for you. That's not. So once everything gets sold, then the resale determines what the prices are, because developer has got holding capacity. That is their sales strategy, to get the maximum profit out. So developer moving the prices up doesn't mean the property has gone up.
Yeah, I think from my point of view, it's not necessarily a bad thing, but it opens up the variables.
Oh yes,
I've had a client who wasn't able to even get borrowing on a new build because we couldn't prove who the builder was and whether they were qualified enough, and so the lender would just turn that down. So
Yeah.
that was a sort of deal loss. That's just one of many examples of, like, the actual build quality. Like, if you're buying at the lower end, the build quality of the home may not be up to scratch. If you're spending 2 mil plus, it's a different story, but there's a whole heap of variables around the releasing, the timing of release. And when you get the existing asset, you've got a proven base there.
Yeah. So my recommendation is like this: if this is the only option, focus on market cycle timing, because that is what is going to get you ahead. Otherwise, there are so many cases, like I think there are more cases of people losing money than gaining money through off the plan purchases. Okay, how can you buy through trust if the holding costs are high in this market? See, okay, buying through a trust is always possible. Holding cost is always going to be high. It basically means that the trust may not be self-sustainable for some time. And people are buying under trust for various reasons. It's not just because they want easier borrowing. It is in many cases, it is asset protection. In many cases, it is land tax avoidance because they want to acquire more assets because each trust is a different entity. So say, for example, if you end up getting into Queensland, right? Queensland has got a land tax threshold of 600 under personal name, but 350 under trust. So you can buy 10 properties under 10 different trusts. If the land value is under 300, you are not up for a land tax. So there are different reasons why people buy under trust, and it is definitely possible because there is not much difference, right? If you can borrow under personal names with most lenders, you should be able to buy, and not with most recently now, with the recent changes that have happened, but with many lenders today, still will you should be able to get a lending under a trust.
Yeah, you can get. It's definitely a legitimate way to get borrowing. I think you just need to go into it with open eyes and make sure you get the right advice. Realize
that is correct.
The extra costs are going to be, there's different tax rules and so on. So
yeah,
I think it's just a more complex part in the journey. Is you wouldn't ever do it in the first purchase, probably. Yeah. So it's just about getting the right advice.
Yeah, and also under a trust, because if the asset is heavily negatively geared, you don't want to be leaving it in trust.
Well, it's
because
just harder
you can't negatively gear otherwise.
Harder than to buy that second one.
Yes, and also that. Yeah. Okay, so nowadays interest rates are so high that holding cost each property costs around $1,500 to $2,000. How can someone hold 5-6 properties in such a situation? Okay, so again, this is very specific, right? Some people can and some people can't, and some people who can't, they are usually buying properties. If their intention is still to buy 5-6 properties, they are not buying properties which are costing them $1,500 to $2,000. There are properties which are going to be costing you much less than this, right? So you just need to do your numbers thoroughly. There are so many ways. And also understand what we are failing to understand here is, because when you are saying 5-6 properties, usually people don't buy those 5-6 properties within 6 months. They are spanning those purchases across multiple years. And say, for example, if you bought your property number 1 today in 2026, by the time you get to your fourth purchase, which could be in 2028 or 2029, then by that time, this property, the yield on purchase would have increased significantly. Because when you are buying a property, you are locking your debt, but what you are not locking is the rental income. So if you are buying in the right markets where there is rental growth happening each year, and you'll really be surprised how this number changes. Once you build a portfolio and you've gone 3, 4, 5 years holding that asset, the rental change, like the rental growth has been phenomenal. Like my purchases, if I talk, properties which were rented at 380 at the time of purchase, they are at 600 now. Properties rented at 600 are touching 900 now. Like the rental growth has been significant, and I think looking at the policy changes, I don't think this to be easing anyway. So your rental will also keep getting better, which helps you again in your holding cost, which keeps reducing. So yeah, you just need to do your numbers before making a purchase. That is what I always wanted to say. You don't want to be in a position where you do the purchase and then realize like it's too tight for you to hold. What platforms do you recommend to find these numbers? I'm not sure what numbers are you referring to. So if it is the demand and supply.
Rohit, this question was asked when we were talking about the metrics like inventory, stock on market, days on market.
Oh, okay. There are multiple platforms. There are multiple platforms. There are platforms like DSR data, hashtag. There are platforms like Stash. Like there are multiple platforms that you can source these data from. And also you can go to Cotality, RP data. You can source these from Cotality. You can also source this from Price Finder. So each of these platforms provide you a lot of data metrics and their trends at suburb level.
And how do you, is that the same sources that you use, or?
Oh yeah, see, we use those, but again, see, it's not just about the data, it's about comprehending the data, right? So I have worked in the data space like yourself with CB, and my last role was a data engineering manager, where I was managing team of data engineers and senior data engineers, right? So looking at a data and comprehending the data are two different metrics, right? So two different things. So that is another thing that you might want to pay attention to. But again, yes, sourcing data is not a problem. There are so many platforms that you can get access to. We use 3 to 4 platforms to cross check, because you sometimes see a lot of discrepancy. So you want to make sure that everything else is aligning well. before you make a purchase decision. If CGT discounts are completely removed, buying in company is favorable. Okay. I personally don't see, again, buying under a company has got different. This is more of an accountant's question than myself. I personally view if CGT discounts are gone, and I've done a few. So in my last podcast, I've discussed this, and also another article that is being published. I think there was a Yahoo article published last week on Yahoo Finance, where I provided my inputs there. And there is another article coming on smart property investment, I think on 26th, where I've exactly covered this topic. See, I wouldn't say buying in company is favorable. And I do. Another thing for you to understand is because policies like this, could just be proposals and may not end up happening. And also these proposals, even if they get implemented, there could be a chance that they get scrapped in next 1 year. But if you buy under a company, you really cannot change the title. So make sure if you make those purchase decisions, or if you change the ownership of the purchases that you're wanting to make based on these policy changes, can revert pretty soon. They can revert back to the previous version, but then your entity structure can't. So just be very cautious when you start changing your structures, aligning with the policies which are ever changing. Each year you would see one policy change or the other, but you really cannot be changing the entity structures of your assets. So just have a little bit of long term thinking when you are making those purchase decisions.
And
Why
Rohit,
isn't
just also pasted the Yahoo Finance link as well in the chat window. If someone wants to read that about article, they
Oh,
can
okay,
click
perfect.
on that.
Thanks. Thanks. Yeah. So why this isn't client's portfolio not diversified too in Perth? So this is a diversified portfolio. See, diversified portfolio doesn't mean that you want to be having. So say for example, if I've got 3 properties in Perth myself, right? But that doesn't mean my whole 13 properties are there. So if a time is right, 2 properties can be in a single location. Because if you're having 4 or 5 properties, problem is when all your portfolio is local, and understand for him, like tomorrow Perth stops and Townsville grows, his portfolio still grows, and vice versa. So this is good enough. And see, if you are getting into the right markets, you don't want to put all your eggs there, but then if you have got good fundamentals, you can still continue to invest in more than one properties. I've got 2 properties in Townsville myself. I've got 2 properties in Melbourne. I've got 3 properties actually in Sydney. Not four actually. I have forgot this office where we are sitting. So yeah, so we have got properties also, multiple properties in a single city. So diversification just doesn't mean that one property, one city. Because if you do that, then the other problem that you'll face is because a boom lasts 2, 3, 4 years. If you are only buying one property, then it means in 3 years, then you could just be buying one in every city. But if your acquisition phase, as I earlier said, is going as fast as possible, as hard as possible, you probably want to make one or more purchases in a single year, which means that you have to be tapping into the same market. If not for the second one, then maybe for the third one. If your time frame of purchase is smaller.
It's not easy to research the markets that are going to grow.
Oh yeah,
Right,
but
I
that's
mean-
what we do every day of the week. Yeah,
Yeah. So when you know that there's an opportunity waiting, why not double down?
100%.
Yeah.
That is what we did, because these purchases also were in 9 months, right?
Yeah.
So in 9 months, like every 3 months, you can't find another new market pumping, right? You know that this is a good potential. I have diversified. So if you see, his first purchase was in Townsville, but second was in Perth, because we diversified. But then we saw that he was ready with his third purchase, but just for the diversification, I can't take him into a market which has got low potential for growth. I again took him back to the same market, and then fourth one again back to the same market. So we bought 2 assets in 2 different markets, but if you see the sequence, that has changed. Hope that helps. Who is the right person to structure the portfolio, broker or accountant, if one chooses to get property in joint names? Okay, so for joint names, I don't think you are talking. Okay,
Yeah, probably.
it's a combination of all. Okay, so a broker will give you an accounting advice. Sorry, an accountant will give you an accountant advice, but a broker will discuss, as he rightly mentioned, regarding your goals and what do you essentially want to achieve, so that he can then start giving you right recommendations on the structures. But then you're also mentioning joint name, which I personally think an accountant and a broker combined should be guiding you on.
I think it's hard to not involve an accountant when you're building a property
100%.
portfolio, because there's always going to be a tax component.
That is correct. Yeah.
It's at the back end because you can't claim that tax rebate until the end of the year. But the accountant really needs to know how you're structuring things. It may not be company or corporate structures, but They need to know which loan ties to which property, and so that they can put the right treatment on it. And
Yep.
if you just dump them a whole list of numbers at the end of tax year, they might not be so sympathetic. So I think working with them and
That is correct.
is
At the
going to
time
really
of
help.
purchase, yeah. Okay, how would you know that a mortgage broker is not doing cross collateralization, and who can help in structure, broker, accountant? Okay, so you just be very upfront and ask them specifically. That's what I advise all my clients. Like when I hear those terms, which are a red flag for me, but I do that on the basis of my experience now. But just be upfront and ask them, are you cross collateralizing my loan? Because if they are, then I would not think any accounting to be lying to, any broker to be lying to you. So they'll just be very upfront and tell you. They might start giving you positives and why they are doing that for you, but they will.
I think probably, and there's a few ways this can play out, but one big red flag would be that if you own two properties, but you've only got one loan, so one account in your bank. So, it starts off at maybe 600, you buy the second property for another 600, and you've got a new loan for 600, a mil or more. That's likely to be cross collateralization.
Yeah, that's for sure.
What we'd want to see is probably 3 accounts actually, or 4. So one with the original loan, a second with the equity release, a third account
For a new loan
with the second property, and then maybe a fourth for an equity release on that. You really want to start separating into different accounts within the bank the purpose of what the loan is for.
Yeah.
So I think that's
a big red flag for me is like when someone says that I'm not taking any equity out, but they're using an equity in the back end. It basically means to me that it could be cross collateralizing, because if they're not creating a separate split and they're not taking the money out, then to me it looks like if it is having, then they might be creating separate splits, which they've done in one of my case, and that was an intentional cross collateralization done, but that was intentional for us very different reason.
Yeah, you can split loans between P&I and IO, and so it might look
That
like
is it.
So
I've got cross collateralized only this office with one of my personal purchases in Perth, but that was a very specific case, because in that case one was commercial lending and one was resi, and they were able to do things being commercial which otherwise I couldn't. There were reasons, but I again always against cross collateralizing.
Yeah, I think you could legitimately ask your bank that question if you were really concerned.
Yeah, just ask them and they'll be telling you. And if one chooses to get property, okay, and who can help us in the structure? So it's the broker and the accountant combined. So they can guide you on what structure you should be going in. And then also, if you're working with the buyer's agent, then they can also give you some tips and tricks there. Is it investing the right approach to save borrowing capacity? Again, depending which markets you are active in, where do you live, right? Say, for example, if you're living in a very expensive city like Sydney, and then yeah, rent investing starts making a lot more sense. If you happen to be in a city which has got which is poised for capital growth, right? If you happen to be in that city, then buying a principal place of residence could be a better choice, because all those gains can be tax free. But then where you are living is not in your control today. But if you know how to read the market cycle timings and the time of your purchase, you are you are at the right place at the right time, then yeah, in that case only PPR makes sense. Otherwise, rent investing is one of the greatest strategies. Yeah. What's the best company structure advised for? Okay, so I can't give you that advice because I'm not allowed to, and also not falls under a remit. So it is the accountant or a financial planner who should be giving you this advice, that what's best company structure for multi-property portfolio.
Yeah, so the accountant and the advisor can help give you the advice. They can set the structures up. Where I would come in as a broker would be then getting you the loan.
That is correct.
I can to get the finance, but not offer the advice on how it gets set up. So these things are purposely split up like this. So
that is correct. Yeah.
There's different types of regulations in this space, which I think is a good thing, because it means that people can specialize in their own area and the consumer's protected.
Okay, so I don't see any other questions. So before we wrap up, we'll just give a couple of minutes. If anybody has got any more questions, we are more than
Rohit,
happy to answer.
there are few questions I think privately message. I'm gonna copy paste those and put it in the everyone so that everyone can see it. These two questions was asked.
Is it easy to start building portfolio if you have deposit and equity? If you have a deposit and equity on my first property, and also in terms of lending perspective, what exactly is cross collateralizing? Okay,
There are
I'll
two
let.
questions. These are two questions.
Oh, okay. Okay, so I'll
The
first
f-
try to answer the first one.
hmm.
Is it easy to start building portfolio if you have got deposit and equity on my first property? Okay, so deposit slash equity is one and the same thing because they solve your deposit problem. See, for making any purchase, what I always keep saying is you need three things. The first is deposit, the second is the borrowing capacity, the third one is the an emotion to buy, a desire to buy, right? So if you have got all but you don't have a desire, the purchase won't happen. But if you have got the desire, you have got the borrowing capacity, you don't have the deposit, you will probably find ways to arrange a deposit. If you have got a desire, you have got the deposit, not the borrowing capacity, you'll start working with best brokers and understand how you can get a borrowing capacity sorted, right? So in your case, you have got your deposit sorted and you are asking this question. So I'm assuming you have got a desire. So now you need to be speaking to a broker to see if you have got the borrowing capacity. And then if you have, then you also need to be then start working with them on the plan, or we do that as a professional as well. So we can help you formulate a strategy to first discuss your goals and then formulate a strategy to reach that goal.
I think there may be a hidden question in there about how much equity you've got. Just because RP data or domain says your property's worth $1 million now doesn't actually necessarily mean, and maybe you bought it for 600,000, doesn't necessarily mean you've got 400,000 of equity.
Always, yeah.
Sort of on paper, maybe, but the banks might not see it that way.
Yep.
They're very much likely going to value it less, and they'll release a lower amount. So that's just something that
The
you
broker
won't
can
know. Yeah, absolutely. A broker can know
advise you.
what the actual number is, and
Yeah.
that you can then use for the second or future purchase.
Okay. Okay, yeah. So speak to a broker. I think they'll sort you out here. What exactly is cross collateralization? Yeah, I'll leave it to you
Yeah.
to
Okay.
answer.
So cross collateralization. I really hate the. I wish there was another crossing. So essentially, this is something you won't ever bump into in the first property purchase.
Yeah.
So when you buy your first home, you've got a sum of money you're going to use as your deposit, and you're going to get a lender to lend you the rest of the money. No issue. This collateralization comes in the second purchase where you maybe don't have all the money for your deposit. And so you're thinking creatively about how I can find that deposit money. The first thing to do is to go to what growth have you seen in your first property? What equity have you got? Now, let's just say, for example, you've got properties grown by 200,000. And let's say the lender will say you can take out 150, just as for argument's sake. The cross collateralization path would be that you go buy that second property and the lender just gives you a new loan that's combined. It's property number one, number two merge, or the loan for both properties just merges into one. So you have one big loan now, one account in your bank, and they're essentially tied together. So the issue that's essentially what it is, and it creates this issue where if you want to then release for the third property, you've now got two places that are tied together. So the equity release on the third becomes a lot harder. So I hope this is explaining it in the right way, but it's good from the lender's point of view because they've tied you into a sticky position.
Yep.
And it just reduces your flexibility to release any equity on those first two properties for your third purchase. And so, yeah, the alternative is to keep everything in a very separate manner and in different accounts, not linked, having the loans disconnected from each other. When you release equity, you really want to be doing that for investment purposes, having a separate loan, separate mortgage. And that is essentially the opposite of cross collateralizing. That's how I see it. There's probably a few different ways to explain it. I hope that
Yeah.
anything else that you could add.
Yeah, no, I think that's it. See, collateral basically means the security, which is essentially your property. So cross collateral means basically two loans or more secured against two collaterals. So it's like cross, and that's the reason why they say it cross collateral. So your single loan is tied to two properties, and then a property is tied to two loans. So that's how it gets complex and tangled. So for, as Tom has rightly mentioned, So your refinancing, your equity takeout becomes tough because they have to be revaluing all the collaterals and see your total equity position and then only release. So say for example, if you get into a position where you have bought one asset which is rising, then you have made some equity there, but then you have got another asset which has dropped in value, then the blender may not be willing to let you take this equity out. But if they were not cross collateralized, you don't need to touch the property which is not grown. You just tap into the property which has grown, take the equity out and get ready with the deposit for the next one. So for you, it could really be beneficial, not cross collateralizing, but for lender, it is beneficial in a way that they are tying you to that sticky product, which makes you harder to refinance or move to another lender. Or
yeah, on the face of it, it looks as though it's simplifying things, because rather than having two accounts,
yeah,
you just have one. And on the face of
making
it, it looks fine. Like
yeah,
but the impacts get felt later.
that is correct. Yeah.
So
Hope that helps. Yeah.
yeah.
Okay, so another question is, with current war and related economies, is it the right time? Yes, always the right time. I have made my principal place of purchase a massive big purchase. I've signed that contract 2 days ago. Always understand, when in times of uncertainty, there are opportunities. Certainty always comes at a cost. So when there is certainty, 99% people just follow the herd mentality and increases the demand, where you overpay to acquire an asset, as opposed to when there is fear. If see, at this stage, not all markets will be growing. You just need to be very mindful. There are affordable markets with good supply and demand fundamentals that keep rising. And also Australia is a unique place currently, which is much less impacted by these policies and much more impacted by their own internal environment, right? So we have got a very bigger, see, the prices always keep rising as long as there is an imbalance between demand and supply, and as long as you are not hitting the affordability ceilings, right? So the prices will keep rising as long as you are making sure that you are looking at the right market cycle timings, where there is a bigger imbalance between demand and supply and it has not hit the affordability ceilings. These markets will be rising. You may be able to grab a good asset at the right value rather than overpaying in these times. Because also understand, higher interest rate is actually a good thing for you, because you are then avoiding a lot of competition. You are getting a good, probably a smaller debt, because you are getting a good price, rather than down the track when the interest rate has actually dropped, but then you are taking a larger mortgage. Essentially, your interest repayment doesn't drop too much, because then you've got a larger mortgage with a smaller rate of interest. So I personally would take a bigger mortgage, like higher interest rate, but a smaller mortgage, so that it can be paid off sooner. And your mortgage value will keep reducing in 30 years, but this interest rate environment is a lot more fluctuating, right? Like it is going to be dropping much sooner than your overall tenure for the mortgage, if that makes sense. So I think, yeah, if you are picking the right, it's always the right time. It's about what your goals are and which markets can actually help you achieve those goals at that point in time.
Yeah, if you were to get into the wrong market and overpay for an asset that
Well,
puts you underwater, then it's the wrong time.
yeah, then it is definitely wrong time.
Yeah.
Okay, so 10 or 20%, which is better for lending? Again, depends again back on your goals. If your intention, if you've got 20% deposit, if your intention is to buy one asset and not buy anything else, then yeah, why pay LMI? Go for 20%. But I have been in positions where I kept paying 20% for my initial investment properties, because I always had a lot more equity and growth than I needed for my subsequent purchases. But from my property number 6 onward, when I had more than 400,000 sitting in my account taken as an equity out, but for my smaller, even smaller purchases, I got a little bit educated and I always started paying 12% plus LMI, because 12% is a sweet spot where your LMI reduces drastically, but then you also save a lot of deposit, right? So I personally always go for 12% plus LMI in all my investments now, regardless whether I have money or.
And there are even lenders now who are waiving LMI at 90%.
Yeah, which is even better.
The key point is really just keep those additional funds available for future purchases, if that is your plan.
Yeah, because saving that 8%, understand, saving that 8% can get you the next property much sooner. And if your LMI is 5, 10 grand, that first thing gets added to your loan, is not paid upfront, is tax deductible for 5 years. And also, like this property, say for example, you paid additional 10 grand here, but you are able to buy another property 6 months sooner in a market which is rising by 10K each month, you're still better off by 50K. So that is how you can actually use this money.
Yeah, and I
to-
think the only other thing I'd add is just that these are the kind of things that I would walk a broker, me included,
Oh yeah,
would just walk you through. Like really, that's what we're there for. It's just going to present different options. It doesn't. You then end up choosing what you think is the right approach. We
That
just
is
put
correct.
things in front of you. So I would absolutely put in a 20% deposit as an option for someone
Yeah.
compared to a series of others.
Yeah. Okay. And how frequently people refinance? Is it after 8 months or more? See, I don't think people refinance for after 8 months. All you need is an equity for which all you can do is go to the same lender and take a top-up loan. So you don't refinance unless there is a strong reason for you to do that, unless you are getting better rates or unless there is any specific reason. People are usually taking top-up loans. That's what I've done.
Yeah, I think that's quite soon. You don't typically see people refinancing that quick.
That is correct. Yeah.
One reason may be that you want to take advantage of a fixed product and lock in the rates, but that's actually probably not really considered a refinance anyway.
Yeah.
No, things would have to move quite significantly to want to move lender. It's quite a
It's
process.
also cost you money, right? Like you're spending.
Yes, there could be exit fees and
Yeah, there are settlement fees and all that stuff. So yeah, you need to have a strong reason for to do that. And I don't think 8 months is long enough. That is pretty short period. People don't refinance so soon.
no, a typical. Wow, I think it's 3 or 4 years. Is
Yeah,
the
2
typical.
to 4 years, I would say.
Yeah.
Yeah. Any more questions? Okay, yeah, no, so I have got a message. Okay, that's one-to-one. Okay, so we'll move on to the next slide. So this is what I want to discuss again with everyone. So see, so you can have an analogy like this, right? Which is a bit funny. So I'm like a Ferrari, but he's the engine of the Ferrari, right? So I can set you the right directions and the right vehicle, but then you definitely need a strong engine because real estate is a game of finance, right? We cannot do anything unless your finance is sorted. So you need to be working with an expert broker, Tom. So if you want help in turning your 100 into multi-property portfolio, book a strategy session with us and we can map your next 2-3 moves and show you exactly how to scale. So now we will be putting a poll first, and then we will be sharing the link to book these calls with us if somebody is interested. So let's do the poll, Maggie, first, and then. Okay, so would you like us to map out your next steps? Yes, I'm serious. I need help. Maybe I want to learn more. Not right now. I can see only one person answering out of 20. Maybe I want to learn more. Not right now. Great. So it's an equal split. 3 people have responded. We'll give some more time. Okay, so when the poll ends, yeah.
There's another one or another couple.
Yes, I think that's gone.
Yeah.
Okay, perfect. So I think we'll soon be ending the poll.